Hello and welcome to today's webcast brought to you by Compliance Week and Genpact. I'm Kyle Brassa with Compliance Week and I'll be your host. Today's webcast is rethinking third-party due diligence to minimize today's supply chain risk. Before we hear from our presenters, let me review the agenda. We're scheduled to go for 1 hour. After the presentation, we will have a question and answer session. Your questions will be kept confidential and anonymous, so please don't be shy. You can ask your questions at any time using the Ask a Question function on the left-hand side of your screen, and they can be asked to our presenters at the end of their presentation. After the Q&A, I'll wrap up the webcast. This webcast will also offer CPE credit for all attendees. Please disable your pop-up blockers in order to access the exam. To obtain your CPE credit, wait until the webcast is completely over and I sign off. At that point, the final examination will be presented automatically in a separate window. If you have trouble viewing the CPE test or receiving the CPE certificate, please send an email to webcast@complianceweek.com. I'll repeat these instructions at the end of the webcast, so if you missed anything, stay tuned. A few other administrative details. At any time during the presentation, listeners can download the slides from the drop-down menu on the left-hand side of your screen. There you will also find the feedback form for the webcast. We welcome your thoughts as we are always looking to improve your experience. If you wish to increase the slide size, you can also hit the View Slide Full Screen button at the top right of your screen. And lastly, a Help button is located in the upper right-hand corner of your screen for assistance. I'd like to welcome today's speakers. It is my pleasure to introduce Joseph Olam. Joseph currently serves as ABAC Program Director at Alexion in New Haven, Connecticut. Previously, Joseph was part of the finance team at Alexion and oversaw third-party due diligence operations. We also have Jennifer Saperstein, Vice Chair of Covington's Anti-Corruption Practice Group. Jennifer advises clients on compliance issues arising under anti-corruption laws, including the FCPA. An experienced compliance counselor, she frequently conducts risk assessments and compliance program assessments and has developed anti-corruption compliance programs for clients across a wide range of industries. Next, we have Sharon Zeely, founder and CEO of Next Gen Compliance in Atlanta, Georgia. Sharon served as Chief Ethics and Compliance Officer for the Coca-Cola Company, and during her 9-year tenure, the company was recognized nationally for its compliance program excellence. I'd also like to welcome Subhashish Nath, Senior Vice President at Genpact, who leads their enterprise risk and compliance service line globally. Subhashish is responsible for driving growth and new digital solution development in the risk domain, including anti-corruption, enterprise risk management, third-party risk management, internal audit, and SOX. And finally, we have a new Vish of Genpact, and who leads the digital regulatory compliance solutions with a focus on anti-bribery, anti-corruption regulations, including the FCPA and the UK Bribery Act. She supports the T&E compliance transformation and third-party due diligence and risk management solutions through automation and analytics to help organizations reduce costs and improve compliance. It's great to have you all with us, and with that, I will turn it over to Subhashish to get us started.
Good morning, good afternoon, and good evening, everyone. Welcome to what I'm certain would be a truly informative session for all of you who have registered in large numbers. Testimony to the outstanding credentials of our panelists, we've once again gone past the 800 mark in terms of total number of registrations. At a time of intense webinar fatigue, we are truly excited to see your continued response levels to our Compliance as a Service webinar series with Compliance Week. Thank you, Jennifer. Thank you, Sharon. Thank you, Joe. Thank you, Anu. It's my privilege and honor to be able to moderate such an esteemed panel, and I do sincerely appreciate all of you making time to share your experiences. Let me not take too much time, but briefly kind of talk about the key themes that you would hear from the panelists. A fair level of focus would be on enhanced activism by the regulators, challenges that corporations face, and leading practices that companies are adopting in dealing with them, including effective leverage of digital enablers. You would get some truly interesting perspectives as Joe brings a corporate lens, Jennifer provides us the legal and regulators perspective, Sharon brings a blend of her Coca-Cola and attorney experience, and Anu would be sharing leading practices from a wide range of customer journeys over the last many years. With that, Joe, if I could start with you, sharing your perspective on some of the emerging third-party risks in the current COVID and post-COVID environment.
Sure, great. Thank you, Subhashish, and appreciate being here as well, and an invitation for the panel. So you can see here on the slide, there are a number of different risks that have come about as a result of COVID. So I'll touch on a couple of them. The first one is location risks. And you can see here that there's a lot of manufacturing centers that were hit hard by the lockdown. Factories were shut down, and it could be for a variety of reasons. It could be based on that location that had a high COVID infection rate. It could also be that there wasn't enough safety protocols. I think a lot of people that are based in the U.S. may know about the meat and poultry industry that had significant outbreaks, and they had to shut those down. And if you are using potentially a sole source supplier in your manufacturing, that could really impact your supply chain. Secondly, there's labor restrictions. And so there are now new health and safety norms. And that actually is a challenge for both employers, those that are potentially trying to recruit employees and put health and safety measures in. Potential employees might be concerned about going to an environment, especially those employees that are qualified, that may be more risky. So there's challenges there. There's limited public transportation available. There's interstate restrictions, intercountry restrictions, and that all leads to these challenges. There's suppressed demand and changing order patterns. So what used to be the normal in a COVID environment has certainly changed. And all of this helps lead to those fraud and bribery risks. So as companies got hit harder, as greater economic pressures could lead people into improper transactions with third parties. So there's lots of risk related to that. And that has some impact. So you can see that companies really struggle to sustain their production volumes. There's distribution bottlenecks. The cash flow issues occur. There's also high penalties and imprisonments. It's really a critical requirement to identify new suppliers, even for those most basic needs, even if they're backup, to continue to monitor existing third-party relationships. Most of the processes followed by companies for such identification are typically really manual. There's really a need for a process which is nimble enough to manage all of this.
Thanks, Joe. Anu, could you share what you are seeing in terms of some of the global trends?
Absolutely. So let me share some statistics highlighting the impact of the pandemic on the global supply chain. Starting with US, we've seen that the bankruptcy filings have been up by 8% in May compared to last year. In fact, the unemployment rates shot up to 13% in May, which is actually the highest since the Great Depression. Moving on to Europe, we've actually seen industrial production drop by 17.5% due to the lockdown, which has been a result of, which has led to actually closure of plants and has impacted the best demand, led to shortage of supplies as well. At a global level,
Anu, we can't hear you, so I guess, we will just sort of continue with that and let sort of Anu, one of our panelists, join back. But at this stage, if I can just request Kyle to switch to the first survey question, please. If you could sort of get that out to the panelists, to the participants. Okay, thanks. Again, I think if I could request the poll results to now be shared with the audience. And with that, Sharon, would be great to hear your views and reflections on what we see as responses from the participants, please.
Sure, Shubhashish, and it's good to work with you again. Thanks everyone for joining. Obviously, we have very astute participants because before onboarding and continuous monitoring are the two leading answers. And I actually think a combination of those two would create a perfect world. If I'm at a large company like IBM or Coca-Cola, I would expect nothing less than doing a screen on the onboard of any third parties that present a medium to high risk, and then continuous monitoring to cover all existing third parties that have been dealing with the company for many years.
Thank you so much, Sharon. Yeah. No, thank you so much, Sharon. Jennifer, if I may sort of come to you and request you to please share your views on some of the more recent regulatory guidelines on third-party due diligence.
Absolutely. Happy to talk about that. Joe had mentioned some of the disruptions earlier that the pandemic has caused for supply chain and also that compliance risk that can create for companies. And to recap, it can occur from supply chain disruptions that are causing companies to consider new business partners or to restructure their existing arrangements, as well as from the time constraints that are putting pressures on companies and compliance professionals in particular. And there's also data that suggests fraud and corruption levels historically increase during times of economic distress, which only adds to the risk. So it's not surprising, given this environment, that we've heard regulators around the world making statements and making clear that they're focused on corruption and fraud and other compliance risks during the time of the pandemic. At the same time, even apart from the pandemic-related focus on fraud and corruption and other risks, we've heard from regulators that they've continued to enhance their expectations for compliance programs, including their expectations for third-party management, wholly apart from the pandemic. In June, perhaps we saw one of the most strongest pronouncements of that trend among regulators. In June, the DOJ Criminal Division updated its guidance on the evaluation of compliance programs. And among the many changes, DOJ added a question on third-party risk management. And what this document is, just for those who aren't familiar with it, the Criminal Division put out a set of guidelines for how it will evaluate compliance programs in the context of a criminal resolution with the U.S. Department of Justice, but it also serves as a really good guide for compliance professionals as to what a best-in-class compliance program looks like, at least to meet the expectations of U.S. regulators like the Department of Justice. So even if you don't find yourself, and hopefully you won't, in front of DOJ because of some sort of allegations of misconduct, the compliance guide is still a really useful set of questions to ask your own company about the compliance program. And in those changes, DOJ added a question this year that asks whether a company engages in risk management of third parties throughout the lifespan of the relationship or primarily during the onboarding process. And so I think for years, companies have known that third-party due diligence is important. It's a key aspect of anti-corruption compliance programs, among other compliance risks. Now DOJ is making clear that third-party compliance measures can't be a one-time exercise and aren't just limited to integrity due diligence. Instead, companies must continue to evaluate compliance risk with respect to business partners throughout the relationship and pay attention to information that arises during the course of the relationship. And DOJ isn't the only regulator that's focused on third-party risk management. Other regulators have as well. So last year, OFAC, the Office of Foreign Assets Control, also issued guidelines, a compliance framework guideline that discusses, among other things, due diligence efforts at various points in a relationship or transaction. In that guidance, OFAC made clear that due diligence on an organization's customers, supply chain, intermediaries, and counterparties is a fundamental component of an effective sanctions compliance program. And those efforts might include a sanctions risk rating and onboarding that then guides the timing and scope of future due diligence efforts. We've also seen guidance from the UK related to the UK Modern Slavery Act, which requires certain businesses to publish an annual statement setting out the steps they have taken to address modern slavery risks, including due diligence processes related to slavery and trafficking. And just this past April, the UK government published guidance for companies on how to approach these transparency statements during the pandemic, which, although that guidance did allow for delay in publishing statements, also stressed that businesses must continue to identify and address these risks. And their statements should consider how changes in their operations during the pandemic might lead to newer increased Modern Slavery Act risks. That same month in April, the EU Commissioner for Justice announced that the European Commission was going to be moving to introduce regulation on mandatory human rights and environmental due diligence for companies. This followed on a study that had been published in February that looked at some existing regulations and a variety of proposals for supply chain due diligence requirements, and assessed a couple of different options. So in sum, when you combine the focus on third-party due diligence and risk management that we continue to hear from regulators, combine that with the focus on fraud and corruption that regulators think will arise during the pandemic and that we've seen arise already, you have an environment where it's particularly important for companies to focus on how they manage their supply chain and other third-party compliance risk.
Thank you so much, Jennifer. Sharon, if I could bring you in on this topic and request you to share some of the recent penalties that have got triggered off related to third-party due diligence practices.
Certainly, Subhashish. As we know, penalties are so important to track because it shows where the regulators are looking and what they're penalizing companies for. Picking up on what Jennifer said, the Economist magazine had an article on COVID Nostra, which is kind of a unique combination, kind of tongue-in-cheek article about international crime. And one of the international experts said the potential for misconduct is unprecedented now due to the pandemic. When the economy grinds to a halt, so does tax revenue. And one large penalty can fund future enforcement actions for more than a year. In the first case, so this is across a wide range of industries as well, and it does focus in part on third-party due diligence. A marine and logistics company, Midship, was fined $871,000. They served as a shipment broker earning commissions, and they dealt in blocked property and interest of blocked property. They did learn during the transactions at issue that OFAC had increased their enforcement activity, and so they put an OFAC clause into their agreement, but allegedly when a large payment was blocked by a bank, one of their staff members in China said to resend the payment without the vessel's name noted in the EFT. So the company was held liable for that because the ship itself, the vessel itself, was an SDN as listed by OFAC. Apple company was reached an agreement with OFAC because they were an app developer for a company called SIS in Slovenia. The majority owner of SIS was Stefanovic, who was an SDN. And two things that were alleged that Apple failed to do: they screened developers of the apps, but not account administrators. And Stefanovic was an account administrator. So that's extremely detailed. Also, the tool that they were using did not differentiate between uppercase and lowercase, so they failed to pick up on an SDN that was SISDOO in all caps. Literally, they had the same letters but lowercase and failed to see the red flag. Touchstone was a medical imaging company. They were fined $3 million because patient information was at risk. They failed to conduct risk analysis and failed to have business agreements in place. Southwest Securities was fined $5 million because they failed to have adequate systems in place regarding the source of deposits, particularly third-party depositors. And Amazon was just released a couple of weeks ago. Their automated sanction screening failed to pick up such things as Crimea spelled with a K. So they're getting more and more detailed in the enforcement actions to companies' detriments.
Thank you, Sharon. So now that one has heard of the increasing regulatory push and implications of non-compliance, Kyle, if we can get our second poll question of the day out to the participants, please. Just by way of information to the participants, we will be sharing the results by way of a blog and a white paper in about a month from now to all of you. So you need not try and take notes and screenshots of poll questions and results. Okay, at this stage, Kyle, if you could push the results out to the participant group. Jennifer, your reflections on the poll results and your independent view on some of the more significant challenges that are faced by the companies in implementing third-party due diligence.
I think these poll results are really helpful and a great jumping off point for discussion. You see two that are in the lead, but there are a number of users who face all of these challenges in each of these categories, and that's not surprising to me. As a compliance lawyer, I probably get asked by clients about third-party risk management more than any other topic. It's a challenging one, and I think a lot of companies struggle with how to make the best use of their resources and how to manage the process. And often, as I think you see reflected in these poll results, I think the one by a couple of users, the answer that has the highest number of responses is multiple ownership, decentralized process. And I think it's very common for companies to have segregated procedures to address different types of risks. There may be an anti-corruption due diligence process that is separate from the sanctions and restricted party screening process, that's separate from the process for corporate social responsibility, that's separate from your financial due diligence, and I could go on and on. But it's challenging for companies to integrate those disparate processes addressing different risks into one coherent third-party risk management process that's less disruptive to the business and to the third parties. And one of the reasons it's challenging, and we'll talk about this, is there are different expectations, and what you do to manage your sanctions compliance risk may be different than what you're doing to manage your anti-corruption risk. The response with the second highest number of selections is limited internal capacity risk management capabilities, and resourcing is always a challenge, and companies face difficult decisions as to who should manage the third-party diligence program. Should it be pushed out to the business to make use of business resources who have it managed centrally by the compliance function or by the procurement department with appropriate training from the compliance function? I think there's a lot of different ways these can be organized, but resourcing is a very common challenge. Some of the other challenges, in addition to the other two flagged here, which are real challenges, manual process impeding scalability and delayed onboarding impact the business. Those are important challenges. And others I'll add to the list. I think sometimes companies can find it challenging to push third-party risk management out to the business, or at least the diligence process. Sometimes that's challenging because if you have a manual process, it can become very challenging to monitor. Also, pushing things out to the business can lead to inconsistent responses to red flags, or red flags that get ignored entirely, and having a manual process just exacerbates this. Technology can help there, but I think one big challenge is trying to figure out when you have red flags, what you do with them and how you respond in a consistent way. And the last challenge I'll mention, although there are many others, is I think just dealing with the results you get, the false positives and the red flags that aren't very clear. So if a red flag in your diligence process is that one of your suppliers has showed up on the SDN list and presents a sanctions risk, it may be easy to know you can't do business with that party. But if there are red flags relating to an ongoing corruption investigation and maybe it hasn't been confirmed, or it's just even muddier, it's just an allegation in a newspaper or a blog post, what do? Do you stop working with the third party? Do you mitigate somehow and take steps to mitigate? And I think all of these are challenges that companies face. And I will turn it over to one of my fellow panelists then to talk about how we address some of those challenges.
Thanks, Jennifer. With that, Kyle, if I can request you to get to the third and the last of our poll questions for today, please. Thanks, Kyle. If you could push the results out to the participants, please. And as the results go out, Joe, if I could come to you next and request you to share some of the practices that you have seen work in your different roles, please.
Yeah, definitely. So looking at the poll results, it looks like the overwhelming majority was a risk-based approach with sanctions for all suppliers. And, you know, when you look at the guidance that was issued by the DOJ, that's kind of what their expectation is. It's not a one-size-fits-all approach, but risk-based reviews. And really to do that, and I think Jennifer did touch on this, it starts with that risk assessment of what are you really trying to do diligence on? And there's many different risk domains you can do due diligence on, and sometimes they're disaggregated. But really, it's first starting with that risk assessment. And each company should determine those vendors that they want to screen, and it should be based on that risk assessment. So you figured out what you want to screen, and then at that vendor and or transactional level, you'll want to start asking questions on the scope of those services. And I think one of the important things is that, you know, and we touched on this before, originally it was about vendor onboarding, but now there's more of an expectation to look at vendors through the whole life cycle. So you can look at your program and do vendor risk assessments at the transactional level to determine if the scope of services of the vendors changed. And you can embed that kind of in your finance process or potentially at the contract process to make sure you're seeing if the risk has changed with a particular vendor. Screening of third parties, including directors, shareholders, subcontractors, that's really important. Also sending those third parties a questionnaire so you can understand from their perspective some of the risks that get response for them on some of the risks aside from just what you're going to get back on a due diligence report. You'll also want to get a service provider that can do these due diligence reports. Some might have expertise in certain areas, but other service providers can really look across all different risk domains. When you're doing the reviews, it's really important not just to get the results, but also make a determination of what to do with that. And consistency is really key. So to make sure make sure as you're reviewing, it's not just approve or reject. Sometimes there's gray areas. And you really need to think through those and think if there's mitigating controls that are required to continue to use that supplier. And you have to work with the business to make sure that you make actionable controls and things that they can actually take action on rather than something that they might not be able to do. So those mitigating controls should really be agreed upon with the business with actual accountability. And the last thing is we talked about the importance of ongoing review. So aside from doing those risk assessments at a transactional level, it's really important to do periodic reviews of third parties. And in the guidance from the DOJ, they really talked about 4 different ways to do that. You can do updated due diligence, which would be really the continuous monitoring or periodic monitoring. You can train your third parties. You can do audits of them, or you can send annual certifications of those third parties to ensure that what they previously agreed on hasn't changed. Or you can do any or all combinations. But I think really important is it really is important to make sure you have appropriate documentation and you're really tracking all your results and there's clear action items that come out of this.
I'd like to add also that when you do the onboarding due diligence, you can submit a questionnaire to the supplier or other third party, which gives you the opportunity to find out if there are higher risks than you think. And at Coca-Cola, we built in an actual training slide at the end to make sure they committed to understanding FCPA and complying with the law in their business practices.
Thanks a lot, Sharon. So what I'll do now is I'll share some best practices on how, basis our experience of working with customers, we've actually helped organizations manage third-party risk management risks. Starting with the first one, which is, performing a risk-based assessment of not just your third parties, but actually doing a risk assessment of the entire landscape, the counterparties, the customers, the joint venture partners, the subsidiaries work with is very important, as the regulator also calls out that a one-size-fits approach does not fit best. Moving specifically to third party, to ensure the segmentation of all your third parties is essential. This typically would focus on areas like the country, specifically the corruption perception index or where the third party is based, the spend we incur with the third party, the types of goods or services the third party is providing, the level of interaction the third party is doing with government officials on your behalf, and finally, whether the third party is deploying contractors for getting work done for you. With that, what I'll also focus on is the next step, which is once the inherent risk assessment is done, there is a risk classification that you would get of all your third parties into high, medium, low. And what we recommend for third parties is for all your low risk, which is exactly what we saw in the survey, we conduct a specific sanction screening, which also translates to your medium and high risk. However, specifically for your medium risk suppliers, the focus is not just limited to sanctions, but includes specific areas of risk management. And if I can request someone to, in parallel, move to slide 16, I will actually show what we're talking about. A previous slide, please. So what you're actually going to see here is the multiple risk dimensions that we want third parties to be looked at. Sanctions for all risk third parties. However, political exposure is very relevant because you want to understand that your third party is related to a government official, is a part of a state-owned entity for countries like China, where you have multiple third parties which are linked with SOEs or relatives of third parties. Adverse media is a very important driver as well, because you want to understand any negative news alerts against a third party, anything on fraud, corruption, intellectual property rights, because all these are relevant areas you want to screen your third parties against. Responsible sourcing is becoming very relevant in today's day and age, where more and more countries are ensuring that acts around child labor, human trafficking, health, safety, and environment are being taken into consideration. So that's another big area for companies that we need to ensure that your third parties are being looked at. Moving on to financial risk, especially in the bankruptcy, in the ongoing pandemic, there is a lot of bankruptcy risk that we just spoke about. So we need to ensure that our third parties don't have are politically as well as financially stable before we interact with them and do business with them. Information security, another big area which is coming across. So you need to ensure that the security, data privacy concerns, etc., are all taken into consideration before you onboard a third party. And lastly, the geopolitical risks, which actually need to ensure that you're taking into account any political exposure, political instability of the particular geography, the corruption perception index of the country is all being considered. And lastly, but equally important, are the anti-bribery risks, where you actually need to go through any previous cases of corruption or fraud that your third party has engaged in, so that you could determine an appropriate action plan. Moving on, and again, a part that all our audience also agreed to, that while this risk area is important to a risk-based review is important for your third parties, we also need to ensure an extended due diligence needs to be performed for high-risk third parties, which doesn't focus on just the third parties, but also covers their shareholders, principals, subsidiaries. So if you look at the slide 18, what you'll actually see is this is a real-life example of a particular a company headquartered in Europe, where we were a retail company and we were actually managing the entire process of screening their entire batch of third parties before they got onboarded. For a particular company based in Russia, an insurance company, we ran the entire search against all the relevant risk alerts, which identified no case. However, when we actually ran these same alerts against the same risk drivers for all their shareholders, we identified a shareholder with 10% shareholder.
I think we've lost Anu, and I'll just pick up. I'm not sure I can pick up her example of something that Genpact was working on, but I'm happy to add a couple of thoughts on best practices to manage third-party risk. Anu had talked quite a bit about the initial screening and risk assessment and onboarding, and I just wanted to add something on the ongoing monitoring and periodic screening that we talked about earlier has become the expectation of DOJ and other regulators. And when I think about ongoing monitoring, it can mean a lot of different things to different people. It can mean periodically running the third parties that are in your ERP system through your restricted party and PEP screening list. At some companies, they run the software nightly. Others do it on a more periodic basis. But monitoring can also mean transaction monitoring using data analytics and other tools to flag outlier transactions for closer monitoring when you're in an ongoing relationship with a third party, looking at those transactions. And we're going to get to this in a minute, but some of the most sophisticated companies or companies with the most sophisticated compliance programs are turning to technology to help manage their third-party risk. And we'll talk about the use of digital technologies, but I think there's going to be, I'll turn it back to Subhashish first for our next topic.
Thank you so much. Thank you so much, Jennifer, for jumping in. And Anu, if you're back, just go ahead and finish your example, and then we'll come back to the digital enablers.
Sure. Thanks a lot, and apologies, bad connection in India today. So moving, I don't know where I had lost everybody, but, essentially what I was just focusing on is extended due diligence becomes very critical because shareholders, directors form an important part, and if you have sanctions against them, the reputation of the third party and ultimately the reputation of the client comes at stake. So with that, I just want to go back to the previous page on slide 14. If I could just wrap up with a quick review of, So with, the next couple of ones, just quickly focusing on continuous monitoring and timely remediation. As Jennifer mentioned, these are all issues which have been raised by the regulator, that a continuous monitoring program as well as a red flag mitigation program is essential and has been called out in the guidance notes released by the Department of Justice as well as by the Group of States Against Corruption, Greco Europe. Last, I just want to focus on use of digital technologies, where I just want to give a relevant example again, because we were talking about the decentralized process. We were actually here working with a European beverage manufacturer, which had presence in about 90 plus operating units. All units were performing the supplier compliance process independently through manual Excel trackers. We actually went ahead and consolidated all these manual Excel trackers into a single repository and a single dashboard by standardizing the process. And this eliminated a 3-week lag that the entire business had in reporting the results of the supplier compliance status to the corporate management. And also, it also allowed us to fall and management to know where the supplier was or the third party was in the entire compliance journey, so that they could, escalate and elevate and, follow up with the particular supplier because they knew exactly where it was stuck in the compliance process. On benchmarking, just last comment, we've worked with companies that sometimes have 2 days of onboarding timelines, and I've worked with companies with 90-day timelines to onboard a vendor. Finding the right balance to your third-party risk management program is very important, and that's what we help companies strive to achieve.
Thank you so much, Anu. Appreciate you dealing with your connectivity issue. Jennifer, building on what you already referred to and a little bit of what Anu spoke about, could you talk to us about some of the digital enablers that you are seeing companies adopt to enhance their TPDD programs?
Sure. Increasingly, there are sophisticated digital tools out there to help with third-party due diligence and ongoing monitoring, and Anu mentioned some of them. I think machine learning and artificial intelligence can help evolve and improve the alerts that are generated over time to help reduce the number of false positives. And so we're seeing companies start to use that technology. Additionally, companies are increasingly collecting data from different systems and feeding them into interactive dashboards and visualizations. Anu gave one example with many different spreadsheets, but we're also seeing companies collect data from different systems, different ERP systems, third-party due diligence systems, and other systems where they store their data, feeding them all together into interactive dashboards and visualizations and data storage repositories where they can run different tests tests to identify those higher risk transactions. So, for example, a company can connect through some of these sophisticated tools, connect your due diligence software and your ERP system, and then teach the tool through machine learning to help identify whether a third party has gone through the appropriate due diligence onboarding process before they were paid, or in the case of a distributor or customer, before they had an order fulfilled. And this helps companies, rather than waiting for an audit to identify problems and instances where due diligence or onboarding process isn't being followed according to the policy, rather than having to wait for an audit. With the use of some of these tools, a compliance professional can conduct near real-time monitoring to identify those instances where, for example, a customs broker didn't go through the anti-corruption due diligence process, or an IT vendor didn't go through the appropriate cybersecurity due diligence process. And so there are lots of tools out there, and it's, they can be tailored to be right-sized for a company, and some companies are starting with pilot programs, which I always think is a good idea. But I think it's important to know there are a lot of technologies out there to help companies better streamline. It's still important, of course, to have the human resources to look at the results that are coming back, and so I think it's always important to try to start small and focus on a narrow area and make sure you have the right resources to review the data coming out of your technology solution. But I think increasingly we're going to see companies turn to these solutions and regulators expecting companies to be using them, particularly if your company is using data analytics and technology, to make sales, for example. If you can, in a very sophisticated way, using data analytics, target your customers, I think regulators are going to expect you to have those types of capabilities to do something similar with respect to compliance. Anu, I don't know if you want to add anything else to the technology point. You probably have some additional insights.
Yeah, thanks, Jennifer. So, absolutely what resonates with, everything that you said. I'll just add a couple of insights more. Companies typically, like you said, need a system of engagement, which is essentially a single source of truth, which is integrating both your internal platforms as well as external platforms to provide a single view of, your third-party risk management. And by internal systems, I'm talking about your multiple platforms. It could be your performance ratings of your third parties. It could be, third-party audits conducted by audit houses or questionnaires released by audit firms. And at the same time, you also need to connect with external databases to identify, sanctions, financial exposures of your third parties. And all these results need to be, crunched, and you need to provide, and companies need to get a single view of their third-party risk management, like I said, which ensures them to, provide rapid decision-making and know the status of their third parties across the globe. Another big one, which is fuzzy search, which I've heard and, which we've implemented for multiple customers, is, again, I'll give the example of the technology major again, which Sharon referred to earlier, where nearly $500,000 in penalty was paid because, not because the customer did not have a screening software. It was actually because the software was not equipped to deal with spelling challenges, and multiple sanctioned countries are spelled in different ways. So, for those of you, just as an example, Cuba could be spelled as CUBA, but also as KUBA. And because of these, no focus on fuzzy search, these particular cases keep getting missed out. Pattern recognition is another important area where countries like China and Mexico, where actually we see that a lot of, common names with a lot of people have common names. That's another area where you need to put in pattern matching techniques like age, date of birth, the profession of the particular individual to identify whether it is a match or not. Language neutralization, very relevant because most of our suppliers are in high-risk geographies with non-English speaking languages, India, Brazil, China, LATAM, Russia. So you need to interact and deal with your suppliers through workflows. The suppliers need to send back their documents, which would all be in local language. How do you neutralize all of it so that you could review the responses, the underlying documents, and provide a view, identify the red flags, and report to the management? Language neutralization software provide all that. And finally, near real-time monitoring, which is again, connecting with the different databases, data sources, so that we're actually able to go through and identify real-time risks to ensure we're complying with the guidance of the regulators on real-time monitoring and continuous monitoring of third parties. So those are a few things which have helped organizations and which lead to the best-in-class party due diligence program.
Awesome. Thanks, Anu. Sharon, before we hit Q&A, if I could please request you to weigh in with the top 5 elements of implementing a robust TPDD framework program.
The screening, of course, is the first, and I think we've talked about the challenges of false positives. It's the bane of everyone's existence in compliance because it's so time-consuming. But the screening, and I would say documentation. So a great benefit of doing screening is that you have a record then for your auditors to come back later and check on that third party. The second is contractual provisions. It's kind of like building a sandwich. Contractual provisions have to go into all of the relevant agreements you have. You can utilize certificates of compliance for those third parties that you don't want to screen so regularly as overnight or every 6 months, especially if you've had a relationship with them and don't have any other indicia of risk. Training, of course, of the various associates that heavily deal with third parties is so important so that they understand the compliance program and know when to call and ask compliance or legal question. And the final element, I think, is the audit. And then again, you have, if you have all of these things, you have a roadmap for your auditors to go by, and they can do sampling when they go in country. For example, to Bolivia, they can pull the third parties that you've identified as medium to high risk and look at the screen, look at the contractual provisions, look at any certificates of compliance and anything else that they can provide.
Okay, with that, Kyle, we can get started with our Q&A session.
All right, thank you, Subhashish. And again, to our audience, we apologize for the technical issues. We appreciate your patience. If you would like a copy of the slides that were just presented, you can download them from the drop-down menu on the bottom left-hand side of your screen. Let's move on to the Q&A part of our session, and I will read these questions from the audience in no particular order. This first question I'm going to direct towards Sharon. Could you please comment on the importance of integrating a third-party due diligence program with the actual contracting or agreement processes as it relates to inclusion of contractual provisions, potential certification requirements, and determining when, if, and how often diligence should be refreshed on third parties? And again, I'm directing that question to Sharon. If you're on mute, your audio.
Thank you, Kyle. Thanks, Kyle. In addition to what I've already said about, building your compliance program to include a foundational third-party risk management, there was one sanctioned company earlier that we talked about where they just built in contractual compliance. And they essentially were fined, I think, significantly as a result of that, because the regulators found out that they discussed heightened risk and heightened enforcement, but all they did was stick something into the contract. They didn't do anything else, or allegedly they didn't do anything else. And I think it's important to keep in mind that it's important to have a well-rounded compliance program and take a look at all of the good guidance that's been provided by the regulators.
Yeah, and Sharon, if you don't mind, I might add to that too. I think just making sure that you have the third-party due diligence done in advance of the contracting always makes sense, because as a result of your third-party due diligence, you may find a need to screen more often or add enhanced controls, which could be potentially language in your contract. And you might have to work with the legal team to potentially, add different things in there, as well as, or if you want to do a certain certification requirement, suppliers may not be willing to do that on an ongoing basis. So having those in your contractual language makes it much easier to actually get the responses you're looking for.
All right, thank you, Sharon and Joe. I'll move on to the next question here. And this one I'm going to direct toward Jennifer. What can third parties do to facilitate due diligence? Well, to facilitate the due diligence being done on them by new potential contractors and employers? Would you ask them to show some type of self-due diligence?
That's a great question. We focused a lot today on what your program should look like to assess the risk of your own suppliers and customers and other third parties. But it's also true that companies are going to be the recipient of third-party onboarding and diligence exercises from their customers, clients, and other counterparties. And it's great to facilitate this. I think the best thing you can do is have a process so that employees in the company aren't just sort of filling those things out and sending them back. It's good to have it centralized in a place to complete these questionnaires. And, often the questions you're getting asked are going to be relatively similar, if not the same. And so having some answers at the ready. Do you know who the company ownership is? If you're not a public company, do you know whether there are any government officials or family members of government officials? Do you know whether you have an anti-bribery policy or a sanctions compliance policy? You'll start to see the same questions over and over again. And so standardizing the responses in one place, I think, can be helpful and allow for some consistency and also saving time. If you've answered a question before, you can copy and paste your answer, and the next time you get the same or a similar question. In terms of doing self-due diligence, I'm not sure I've worked with any companies that have done this, but it's not a bad idea to run a diligence report on your own company the way you would on one of your suppliers' advisors, because then you'll get a sense of what issues are going to come up. And I have seen it where I worked with a company that was doing diligence on a number of their third parties, and there was one, I think it was a corruption-related allegation, and the supplier had a written response at the ready. It was clear that a number of multinationals had done their diligence, had come across the same allegation as had asked the company about it, and they were ready for the question. They did have an explanation for it, and they were ready to receive the question and respond very promptly. And so getting a sense of what issues might come up if somebody runs a diligence process on your company, I could see being very helpful.
All right, thank you, Jennifer. And we have time for just one more quick question here. This one will go to Joe. Adding risk assessment processes will increase my onboarding time. How do I balance operational requirements and compliance?
That's a really good question. I think a lot of it has to do with making sure that those that are completing those risk assessments are really understand the purpose why. So that can be done through training and getting the business to really understand the importance of that risk assessment and even why we're doing diligence. It might be more work up front, but it may limit the liability of companies and will avoid treating potentially all vendors equal. All vendors are different. And ways you can do this might be doing some scenarios with them or where things went wrong, but it's a really good practice to really get them to understand the reason and that it might help to actually overall mitigate the risk of the company. But on top of that, it might also result in less diligence once we understand the supplier relationship better.
All right, thank you, Joseph, and thank you, everyone, for a very informative session. Again, our speakers today were Subhashish Nath, Joseph Olam, Jennifer Saberstein, Anu Vish, and Sharon Zeely. And I'd like to give a special thanks to Webcast for making, special thanks to Genpact for making this webcast possible. Once again, to obtain your CPE credit for this presentation, please disable your pop-up blockers in order to access the exam. The webcast will close automatically and the final examination will be presented in a separate window. If you have trouble viewing the CPE test or receiving the CPE certificate, please send an email to webcast@complianceweek.com. This webcast has been recorded and will be available later today to Compliance Week members on our website under the Webcast tab, which also contains the library of additional CPE webcasts. If you'd like to learn more about becoming a member, please contact us at info@complianceweek.com. This concludes our webcast. Thank you again for joining us and enjoy the rest of your day.